Investing is a powerful tool for building wealth and achieving financial security. It's a journey that spans decades, not days. Choosing the right investment vehicles is paramount to success. Vanguard ETFs have emerged as a cornerstone for countless investors, particularly those seeking long-term growth. Vanguard ETFs, or exchange-traded funds, are investment funds traded on stock exchanges. They offer a unique combination of benefits that make them ideal for long-term investors. Low costs are a hallmark of Vanguard ETFs. Their low expense ratios mean more of your money stays invested, working harder for you. Diversification is another key advantage. Vanguard ETFs provide instant access to a basket of assets, such as stocks or bonds. This diversification helps mitigate risk by spreading investments across different sectors and asset classes. Simplicity is a defining feature of Vanguard ETFs. They are easy to understand and manage, making them suitable for both novice and seasoned investors. These core principles of low costs, diversification, and simplicity form the foundation of a successful long-term investment strategy with Vanguard ETFs. Whether you are just starting your investment journey or are a seasoned investor, understanding these principles is crucial for maximizing your returns and achieving your financial goals. Age-based allocation is a prudent investment strategy that aligns your portfolio with your time horizon. It recognizes that your investment goals and risk tolerance evolve as you progress through different life stages. Younger investors with a longer time horizon can typically afford to take on more risk. They have more time to recover from market fluctuations. As you approach retirement, preserving capital and generating income become increasingly important. A more conservative approach with a greater allocation to bonds may be appropriate. Age-based allocation provides a framework for adjusting your portfolio's risk profile as you age. While age serves as a useful guide, it's not the sole factor in determining your asset allocation. Factors like risk tolerance, financial goals, and market conditions should also be considered. A well-defined investment plan should be tailored to your unique circumstances. Building a diversified portfolio is like constructing a sturdy house. You need a strong foundation. Vanguard ETFs offer a wide range of building blocks to construct a robust and diversified portfolio. For U.S. stocks, the Vanguard Total Stock Market ETF, or VTI, provides broad exposure to the entire U.S. stock market. It includes large, mid, and small-cap companies. For international diversification, the Vanguard FTSE Developed Markets ETF, or VEA, offers exposure to developed markets outside the United States. The Vanguard Total Bond Market ETF, or BND, provides comprehensive coverage of the U.S. bond market. Bonds are generally less volatile than stocks and can provide stability to your portfolio. These core Vanguard ETFs serve as the cornerstones of a well-diversified portfolio. They provide exposure to a broad range of asset classes, helping to mitigate risk and enhance potential returns. Your investment strategy should evolve alongside your life stage. Here are some general guidelines for different age groups. In your 20s and 30s, this is the growth phase. This is the time to embrace risk and focus on growth. A portfolio heavily weighted towards stocks, about 80 to 90%, with a smaller allocation to bonds around 10 to 20% is suitable. In your 40s and 50s, this is the accumulation phase. As you approach your peak earning years, balancing growth and stability becomes crucial. Gradually reduce your stock allocation to 70 to 80% and increase your bond allocation to 20 to 30%. In your 60s and beyond, this is the preservation phase. Preserving your nest egg and generating income for retirement take priority. Shift towards a more conservative approach with a higher allocation to bonds, about 60 to 70%, and a smaller allocation to stocks around 30 to 40%. Remember, these are just general guidelines. Your actual asset allocation should be based on your individual circumstances and risk tolerance. Section 5. The importance of rebalancing, staying on track over time. Rebalancing is the process of periodically adjusting your portfolio to maintain your desired asset allocation. Over time, market fluctuations can cause your portfolio to drift from its target allocation. For instance, if stocks outperform bonds, your portfolio may become overexposed to stocks. Rebalancing involves selling a portion of your overperforming assets and reinvesting the proceeds in underperforming assets. This helps you maintain your desired risk profile and avoid becoming overly concentrated in any one asset class. Rebalancing should be done periodically, such as annually or semi-annually. It can also be triggered by significant market movements. Rebalancing is an essential part of maintaining a well-diversified portfolio and staying on track to reach your long-term investment goals. Section 6. Target Date Funds, Simplicity and Automation in Investing. Target date funds, also known as life cycle funds, offer a simplified approach to age-based investing. These funds automatically adjust their asset allocation over time to become more conservative as you approach your target retirement date. For example, a target date fund with a target date of 2050 would have a more aggressive allocation to stocks in 2025 than a target date fund with a target date of 2030. Target date funds are a popular option for investors who prefer a hands-off approach to investing. They provide a convenient way to benefit from age-based allocation without having to manually rebalance your portfolio. Vanguard offers a suite of target date funds, each with varying asset allocations and risk profiles. When choosing a target date fund, it's essential to select one that aligns with your target retirement date and risk tolerance. Section 7. Beyond the Basics, Tailoring Your Strategy. While age-based allocation provides a solid framework, it's essential to tailor your investment strategy to your unique circumstances. Factors such as risk tolerance, financial goals, and market conditions should all be considered. Your risk tolerance refers to your ability to stomach market fluctuations without making rash decisions. If you have a high risk tolerance, you may be comfortable with a more aggressive portfolio. If you have a low risk tolerance, a more conservative approach may be appropriate. Clearly define your financial goals, such as retirement, buying a home, or funding your children's education. Your investment time horizon and the amount of money you need to accumulate will influence your asset allocation. Market conditions can also influence your investment strategy. During periods of high market volatility, it may be prudent to reduce your stock allocation. Conversely, during periods of market stability, you may consider increasing your stock allocation. By carefully considering these factors, you can create a personalized investment plan that maximizes your chances of success. Section 8. Case Studies, Real-Life Examples of Age-Based Investing. Let's examine how investors in different age groups might allocate their assets using Vanguard ETFs. Sarah, a 30-year-old professional, has a long-time horizon and a high-risk tolerance. She can invest aggressively in stocks. Her portfolio could comprise 80% stocks and 20% bonds. David and Emily, a couple in their 50s, are saving for retirement and have a moderate risk tolerance. They need a balanced approach. Their portfolio could consist of 60% stocks, 30% bonds, and 10% in a target date fund aligned with their retirement date. Robert, a retiree in his 70s, has a primary focus on capital preservation and income generation. He needs a conservative portfolio. His portfolio could be structured as 40% stocks and 60% bonds. These case studies illustrate how age-based allocation can be tailored to different life stages and risk profiles. Section 9. The Long View, Maintaining and Adjusting Your Portfolio. Investing is not a set-it-and-forget-it endeavor. It requires ongoing monitoring and adjustments. Regularly review your portfolio at least annually to ensure it still aligns with your financial goals and risk tolerance. Rebalance your portfolio as needed to maintain your desired asset allocation. Life events such as marriage, the birth of a child, or a job change can impact your financial goals and require adjustments to your investment strategy. Stay informed about market conditions and economic trends. While it's essential to avoid making impulsive decisions based on short-term market fluctuations, significant shifts in the economic landscape may warrant adjustments to your portfolio. Remember, investing is a marathon, not a sprint. Patience, discipline, and a long-term perspective are essential ingredients for success. Section 10. Conclusion. Secure your financial future with Vanguard ETFs. Building a secure financial future requires careful planning and disciplined investing. Vanguard ETFs offer a powerful and accessible tool for investors of all ages and experience levels. By embracing the principles of age-based allocation, diversification, and regular rebalancing, you can harness the power of compounding to grow your wealth over time. Remember that your investment journey is unique. Take the time to understand your risk tolerance, define your financial goals, and tailor your strategy accordingly. Vanguard ETFs provide the building blocks for constructing a robust portfolio that can weather market storms and help you achieve your financial aspirations. Start investing today and embark on the path to financial security with Vanguard ETFs.